Karan Taurani joins in, and I think 405 thereabouts, Karan, that was the listing. Second largest e-commerce and food delivery player. What do you make of its listing today?
Hi, Avan. Morning. I think the listing has been largely in line. I think the valuations were quite fair if you compare this to the larger peer and market leader like Zomato. I think broadly in terms of metrics, even in terms of the Q1 performance, we have not seen any kind of big change. So if you look at the revenue growth, the scale difference on the food business side remains to be at about 25 to 26 odd percent. If you look at the quick commerce side as well, therein the gap is also more than 40-45%. So I think there has been no change in terms of Q1 FY25 performance for now. I think the only change has been in terms of Zomato food business reporting a better profitability. They were at last year break even at about in FY24, which is potentially moved to 0.8% EBITDA as a percentage of GOV. Even the losses in the quick commerce side basis Q1 numbers have not seen any kind of change on an annualized basis. So clearly a long way to go in terms of execution. Three, four things that we need to watch out for. One is the growth rates for Swiggy. Because the scale is smaller, Swiggy should potentially grow at a higher pace versus Zomato in the food business side. Whether that happens or not is a key monitorable. Second, of course, is that with scale, what we have seen that Zomato has gathered very strong EBITDA margins on the food business side. So with the potential growth, is Swiggy able to execute better in terms of profitability? Can they kind of inch closer towards that 2.5-3% adjusted EBITDA as a percentage of GOV mark? Third thing is that they've lost market share on the quick commerce side because of increased competitive intensity from Zepto. And this segment is only going to see more of competition because of the larger e-commerce players. So can Swiggy, kind of potentially gain back that market share? What are the kind of growth rates there? And lastly, I think the improvement in terms of take rates in quick commerce, which is a very big gap versus Zomato, and eventually the narrowing down of the losses. So these are 3-4 monitorables for Swiggy, which will kind of lead to some kind of upside from current evaluations. And basis the performance, we'll see upside over the near to medium term.
Yeah, and I'm going to just take a leaf off from Zomato's latest tweet. It's got both Zomato as well as the Swiggy delivery personnel looking at the Bombay Stock Exchange, wherein the ticker runs now listed Swiggy with a green uptick arrow there and says, "You and I in this beautiful world, heart." Karan, so just taking a leaf from what you were mentioning, Zepto versus Blinkit versus Instamart. Who's going to really win the race here, you think?
So I think if you look at the numbers right now, Blinkit clearly has an edge amongst all the three players, not only given the market share numbers, but also given the premium take rates, given the higher AOV. So the metrics are also superior. Getting back to these kind of metrics from the competitors, obviously not an impossible task, but it is going to be some challenging, to kind of get back to those kind of metrics in terms of premium AOV and premium take rates. So I think, if you look at the market right now, we are well positioned wherein Instamart and Zepto are largely neck to neck in terms of competition. And not only them, I think, this space has got a very huge target market in terms of total addressable market. The size can be extremely big as compared to the food market, which is about $8-10 billion today, will grow at 18-20% on a steady state. The quick commerce market can be extremely big. I mean, it's at about $4.5 billion today. There is a potential for this market to even breach $30-35 billion over the next 5 to 7 years. So that's the kind of market we're talking about in terms of potential sizing. So clearly there is ample opportunity for many players to coexist here. Now, which way does the market move will be the deciding factor. Larger e-commerce companies have made plans to enter this segment aggressively. Amazon, Flipkart, even Tata Neu to some extent. So I think do they do discounting? Do they only counter on user experience? What is the kind of strategy that they're going to adopt in this entire quick commerce market? Which are the kind of verticals that they'll target? Can this quick commerce market scale up beyond the metro markets on a sustainable basis? I think these are broad questions to answer. So we'll only get the answers to this over the next near to medium term in terms of how things pan out.
Now the choice is, see, Karan, the big picture is that quick commerce and food delivery is here to stay. It's a high growth business. 25 to 40% is the estimate. 25 being the most conservative, 40 being the most optimistic. So this sector, I think, will be a high growth sector. The question is that between Swiggy and Zomato, Zomato is available at a market cap of 2 lakh crore, Swiggy sub 1 lakh crore. Is it time to buy Swiggy and flip out of Zomato, or still ride Zomato till the time Swiggy is able to deliver something concrete?
I think the answer to that is that it's still, you have to ride Zomato for now, given the kind of track record and the good execution we have seen from Zomato's side. So I think the discounts, what we have seen invariably is because of a reason. It is not just pure valuation multiple discount. I think the discount of 60% that we see today on Swiggy versus Zomato is because of three reasons that we've articulated in the past as well. One is, of course, the revenue scale. So if you take an average in terms of food and quick commerce, the revenue scale difference is around 35 to 40%. So that's one discount. The second discount is also because of hyperpure. So Zomato has got this B2B hyperpure business, which is 10 to 13% of their valuation. That's not there for Swiggy. So roughly around, about 40-45% from there. And then you've got valuation multiple discount, which is almost about 20-25%. So I think only thing that can kind of change here, if probably, let's say, Swiggy performance improves in terms of better growth rates versus Zomato, and if they reduce this gap in scale, you will see valuation multiples discount also converge. So net, I think in a best case scenario, this 60% gap can move to a 40%, which means that Swiggy will see a 20% upside from current levels. But that is too much of an ask for now, because as I said, in the near term, in FY24 numbers, in Q1 FY25 numbers, we still haven't seen any kind of visibility of any major trend. Basically in terms of quick commerce majorly, I would say, because that drives the bigger delta in terms of valuations and growth. So unless quick commerce doesn't see a scale in terms of better AOV, in terms of higher take rates, or in terms of sharp reduction in losses, we will not see Swiggy move up from here on. And basis the discount, I think, as I said, basis the track record, execution, the historical performance, we would rather prefer a Zomato over Swiggy at current market price.
Karan, appreciate your time. Thank you for joining us on.
If you like this video, then like, share and subscribe to ET Now.